A credit card looks simple. You tap a piece of plastic, the screen says approved, and you walk away with something you have not paid for yet. But in those few seconds, no money moves directly from your card to the shop. Instead, several companies exchange messages, judge risk, reserve credit, calculate fees, and promise that the money will arrive later. A credit card is really two systems joined together. One is a global payment network. The other is a revolving loan. Here is what happens when you buy something. The merchant's terminal reads the chip, contactless signal, or digital wallet credential. It creates an authorization request containing information such as the amount, merchant, card credential, and security data. That request usually travels first to the merchant's payment processor or acquiring bank. The acquirer serves the merchant. It sends the request through a card network, such as Visa or MasterCard, which routes it to the bank that issued your card. The card network normally does not decide whether you can borrow. Your issuing bank does. In a fraction of a second, the issuer checks whether the account is active, whether enough credit is available, and whether the purchase looks suspicious. It may compare the transaction with your location, spending history, device, merchant type, and many other risk signals. The issuer then sends back one of two answers: approved or declined. An approval does not mean the merchant already has the money. It means the issuer has authorized the transaction and usually reduced your available credit by that amount. The purchase may appear as pending because the final amount has not yet been cleared and settled. Later, the merchant submits completed transactions for capture. During clearing, the participants exchange the final transaction details and calculate what each party owes. Then comes settlement. The issuing side transfers funds through the network to the acquiring side, and the acquirer funds the merchant according to its agreement. The merchant normally receives less than the sticker price. Part of the difference may include interchange paid toward the issuing bank, network fees, and charges from the acquirer or payment processor. The exact structure varies by card, merchant, country, and agreement. This helps explain a common mystery. How can some cards offer points, miles, or cash back? Card issuers earn money from several places. They may receive interchange when the card is used. They may collect annual or other account fees. And when customers carry balances, the issuer earns interest. Rewards are part of the competition for spending, funded by the broader economics of the card system. After settlement, the purchase becomes part of your credit card balance. Your card is not withdrawing money from your bank account like a debit card. The issuer has paid the merchant side and created a debt that you owe to the issuer. During the billing cycle, new purchases, payments, refunds, fees, and interest are recorded. At the end of the cycle, the issuer creates a statement showing the statement balance, minimum payment, due date, and available credit. This is where the second system, the loan, becomes important. Many cards offer a grace period on purchases. When they do, paying the full statement balance by the due date can allow you to avoid interest on those purchases. But grace periods and rules vary, and cash advances often work differently. If you pay only part of the statement balance, the remaining amount revolves into the next cycle. The annual percentage rate, or APR, describes the yearly price of borrowing. But many issuers calculate the actual interest day by day using a daily or average daily balance. That means interest can begin accumulating repeatedly on the balance you carry. Paying earlier reduces the balance exposed to interest. Paying only the minimum may keep the account current, but it can leave the debt alive for years. The minimum payment is not the amount required to use credit cheaply. It is the smallest payment the issuer will accept under the account terms for that statement. Now add security. A chip transaction can create transaction-specific security data, making copied card information less useful than the old magnetic stripe. Digital wallets can replace the real card number with a payment token limited to a device, merchant, or payment situation. Online payments may add authentication tools, such as 3D Secure. These systems reduce risk, but they do not eliminate fraud. When a cardholder disputes a transaction, the issuer, acquirer, merchant, and network may exchange evidence through a formal dispute process. A merchant can lose the payment if the dispute is decided against it. Consumer rights and deadlines differ across countries, so local rules still matter. And that reveals the real machine behind the card. The merchant wants a guaranteed, convenient sale. The customer wants instant purchasing power and protection. The issuing bank accepts credit and fraud risk. The acquiring side helps the merchant receive card payments. The network connects the institutions and enforces common technical and operating rules. The tap feels instant because the system separates the promise from the final movement of money. Authorization happens now. Clearing and settlement happen later. Your bill comes later still. Used carefully, a credit card can provide convenience, rewards, short-term financing, and strong payment protections. Used carelessly, the same design can turn small purchases into expensive long-term debt. So the most important part of a credit card is not the chip, the number, or even the credit limit. It is the timing. The card lets you spend now, while the network, the merchant, the banks, and your future self settle the consequences later.